Hi everyone, very good afternoon and welcome back to CGP Mentors. So let us start today's session. Here we are covering the module C, which talks about valuation, acquisition as well as the mergers, right? So let us start and do the question number 1. So balance sheet of XYZ Limited shows the following figures to you: equity share capital, reserves and surplus have been given, secured loans have been given, unsecured loans have been given, right? And you have been asked that using the investor claims approach, what is the estimated value of the company? You have been asked to value the company based on the investors claims approach. Let us see the solution. Investors claim would be on equity, reserves, secured loans and unsecured loans. So just do the total of this 105 crore. This is going to be the value of your company. Now a company has total assets worth 150 crores. The current liability and provisions on the balance sheet are 30 crores. You have been asked to calculate the company's value using the assets and liabilities approach. Quite pretty easy, simple question, right? You have been provided with the assets and you have been given with the current liabilities and the provisions, and you need to find the value of the company. So obviously whatever is the net assets is our something which is there with us. So total assets less current liabilities is something you'll get your company's value. Now a company owns a plant and machinery with a book value of 18 crores. Due to inflation and market trends, the current replacement cost of the same machinery is 25 crores, right? So you have machinery and the book value of the machinery is 18 crores. But if you'll go to buy the same machinery in the market, you'll get it for 25 crores. By how much should the value be adjusted using the replacement cost approach? कितना आपको adjust करना चाहिए? So obviously 25 less 18. This is what your replacement cost approach talks about. Now, as on 31st March, the Sunshine Limited has 20 lakhs equity shares which are outstanding. Market price per share is 60. Book value of the outstanding debt is 25 crores. Market value of the debt is 24 crores. Now, what is the total value of the company as per the stock and debt approach? See, this approach is important where they are talking about the value of the company as per this kind of approach. So, let us have a look onto it. So, we will find out the market value of equity. Just multiply the number of shares with the market price and you will use the market value of debt. This is what the stock and debt approach talks about, that whenever you have to find the value of the company, use the market value of equity as well as the market value of debt. That is going to give you your value of company. Now, Pearl Limited has 10 lakh equity shares outstanding. Now, on the valuation date, the market price per share was volatile. It was fluctuating between 90 and 110 during the last 15 days. An analyst decides to use the average of last 15 days closing price of 100 instead of the current market price of 90. If market is efficient, what is the best practice as per the stock and debt approach in this particular scenario? Use 100 as it smoothens volatility, use book value, use 90 because it reflects all public information, use 95 as a compromise. So in this particular situation, as per the efficient market hypothesis, the current market price reflects all publicly available information. That means investor knows what is the demand and the supply of this particular share in the market, and this is why the market price is 90, right? So that is why the most appropriate price which needs to be used in the stock and debt approach is 90. That is the current market price. If you would have witnessed it, agar aapne dekha hoga, in the previous question also, when we were calculating stock and debt approach, we used market value only. ठीक है? So that's what the stock and debt approach talks about. An analyst is valuing StarTech, which has earning per share 15, current share price as 180. Now the average price to earning ratio for the comparable companies in the sector is 14. Okay? So what is PE ratio? PE ratio is your market price per share divided by your earning per share. Basically, you don't have to do anything, just 180 divided by 15. You have been given the data of your peers also, that is 14. Now, based on the direct comparison approach, what is the indicative fair value per share of the StarTech Limited? You have been asked the indicative fair value per share. So, fair value you can find out through sector average price earning ratio and what is company's EPS. So, clearly both these have been multiplied and this gives you the fair value of your share. The formula that has been applied over here is of PE as only MPS upon EPS. So if you have to find out the fair value of share, right, that means this only, you will ignore what is existing. You will just use the PE of the sector, multiply it with your own EPS, which is realistic in nature, and that is what will give you the fair value, right? A 4-bedroom flat was recently sold for 7 crores. The adjacent flat has superior features like being a corner unit, large carpet area, dual balconies. Using the direct comparison approach, what is the adjusted value of subjected flat? किस तरीके से आप adjust करोगे? See, the total upward adjustment that will happen is 2% plus 5% plus 3%. What has been the value that has been given of the similar flat but with less features, 5 crores? Just add it, right? So that's what you have added, 7 crores plus 10% of 7 crores. So you will get the adjusted value as 7.70. That means for the features, you have just increased the price. Now a company being valued through direct comparison approach has EBIT of 30 crores, earning before interest and taxes. Comparable listed firms, they trade at an average of EV divided by EBIT multiple of 9x. Now what is the estimated enterprise value of the company? Let's have a look onto it. So over here you don't have to do anything for the expected value, just find out the EBIT and the multiple that has been given. So 30 crore multiplied by 9, this is your 370 crores. Basically what you have tried to find out expected value on the basis of earning के basis पे आपने inflate करने की कोशिश की है, and simply you just have to multiply 30 crores by 9 and you will get the 270 crores. Now, a tech company has an EPS of 25. Peer companies in the same sector, they are having an average P ratio of 18. Now, what is the fair value based on the direct comparison approach? Again, the same thing that has been given to you, 25 multiplied by 18. 450 is your fair value that you have to take into consideration. Next is, a firm is expected to generate free cash flow of 50 lakh, 60 lakh, 70 lakh over the next 3 years. Discounting rate is 10%. So what is the present value of these cash flows? That is discounted cash flows. Easily you can find it out, right? Present value we have done yesterday also. What you are getting in first year, right? What you are getting in the second year, you will multiply this with the factors and you will get your discounted cash flow. Basically 50 lakh rupees which I will receive after 1 year. What is the present value of that today? आज के terms में उसकी क्या value है and how I can find it out? So 10% is something which is my discounting rate over here. So I'll just do 1 divided by 1.1 to find out the present value that it has today. It will come somewhere around 0.91, right, as my discounting factor. Now a company's EBIT is 200 lakhs. It has no debt. The applicable tax rate is 30%. कोई debt नहीं है. That means it will have no interest obligation. What is net operating profit less adjusted taxes? Basically, you just have to do EBIT less in tax rate, right? This will give you your net operating profit after taxes. Oh, obviously, because there is no debt, so no interest payment has to be made and no interest related adjustments are needed. Now, a firm is projected to generate a constant free cash flow of 100 lakhs per year. Now, if the weighted average cost of capital is 12%, what is the terminal value of the firm using the perpetuity formula? Terminal value क्या होगी firm की? So, free cash flow divided by weighted average cost of capital. This is the clear direct formula which has been given to you. Remember that if ever they ask you to calculate the terminal value, you just have to do free cash flow divided by your what is your weighted average cost of capital 012. You will find out the terminal value using the proprietary formula. The perpetuity formula. Now next is, a company plans to raise the 10 lakhs with 40% debt and 60% equity. Post-tax cost of debt. Post-tax cost of debt is 8%, right? And the cost of equity is 15%. What is the weighted average cost of capital? Very simply, cost of equity is 15%. You just have to multiply it with the proportion of equity, and then after tax cost of debt is given, good. If it was not after tax and the tax rate is given to you, please make it after tax, right? Multiply it with the debt proportion and you will find out your weighted average cost of capital, and add these two. Both of these, if we'll add, we'll be finding out the weighted average cost of capital. That's what they have done over here. Now next is ANC Limited. It raises 5 lakhs through debt. 2 lakh is at 10% and remaining 3 lakh at 13%. The tax rate is 30%. What is the post-tax average cost of additional debt? Let's have a look onto it. So the interest, 2 lakhs, 10%, 3 lakhs, you have to pay 13%. Okay, total interest is 59,000. Now what would be the post-tax interest? 41,300. Basically, what is the interpretation? 59,000 is your expense, interest expense, but because when you are paying this expense, you are having a tax saving also. Tax saving means by giving that particular expense in your books, you have saved on giving less taxes, right? So that is why your net interest expense that comes at 41,300. So what is the cost of debt eventually? 41,300 divided by the total debt you have taken, 8.26%. This gives you after tax cost of your debt. इससे आपको आपकी debt की after tax cost मिल जाती है. Right, now ANC Limited has an EPS of 12, a dividend payout of 50. That means 6 rupees obviously you pay as a dividend. Current market price is 60. Expected dividend growth rate is 10%. What is the cost of equity using the dividend discount model? हमें cost of equity calculate करनी है. So over here, what is your dividend per share? 6. Right, now over here, how we are going to calculate the cost of equity? Yesterday also we have done the dividend divided by your market price and plus the growth, right? So over here my dividend is 6, my market price is 60. Find it out and plus the 10% growth rate, eventually it is 20%. ठीक है, ये आपका 20% growth rate आ जाएगा. One thing that I would like to tell you over here, यहाँ पे one more what you can say change that you can do is, has an EPS and a dividend payout of 50%. So right now it is 6. Right now it is 6 rupees, but because 10% growth is there, it could be plus 10%. ठीक है, ये आपका plus 10% हो जाएगा. So over here you would be paying 6.6 next year. This is what we are expecting. So if the 21 is given in the option, यहाँ पे 21 नहीं दिया हुआ है. If 21 would have been given in the option, वो भी आपका correct option हो जाता. Now the constant growth dividend discount model, let's see this. So XYZ expects that the dividend of rupee 1 year from now, the dividend is expected to grow at a constant rate of 6%. If the investor requires return of 14%, what is the fair value of the share? ठीक है, तो यहाँ पे you just have to find out expected. See over here they say that it is expected that next year a dividend of 4 rupees would be given. So that is why we do not have to multiply it with the growth rate, right? आपको यहाँ पे दिया हुआ है रिटर्न चाहिए इन्वेस्टर्स को कितना, 14%. दैट मीन्स कॉस्ट ऑफ इक्विटी हैज बीन गिवन, expected dividend next year is given. You have to find out the market price of the share, right? And plus the growth rate is also given, right? You can easily solve this particular question. Now zero growth dividend discount model. So ABC Limited is expected to pay a constant dividend of 6 per year. If the required return is 10%, what is the fair value of the share using the zero growth dividend model? So in that case, see 6 divided by your rate of return that has been given, 10%. This is your zero growth dividend model and this is what you are expecting. Now, two-stage growth dividend discount model. A company is expected to pay a dividend of 4 rupees next year. The dividend is expected to grow at 20% per annum for the next 2 years and then 10% indefinitely. Now, if the required rate of return is 15%, what is the intrinsic value of the share? आपसे intrinsic value पूछी है C. Over here, first of all, you need to find out the projected dividend in the year 1. We are expecting 4 rupees. After that, we are expecting 4.80. After that, we are expecting 5.76. Why? Second year plus growth rate. Third year plus growth rate, right? After that, the growth rate would stabilize. So, what would be the price in the third year? The dividend of fourth year, expected dividend, rate of return less growth rate, the stabilized growth rate. You said na that after year 3 your growth rate is going to stabilize at 0.10. Solve it. This is the value for the last year. So now let's discount it to the present, right? How you have discounted it? Whatever you are earning, you will be getting 4 rupees. What's the value of this as of today? You will be getting 4.80. What is the present value of this at 3.626? 5.6 you will get in the third year. What is the present value of it? And in the fourth year, you will be getting the price, that is 126. We have discounted it for the present value. Discounting rate we are using 15%, right? And gives me total present value at 94 rupees. So basically you have discounted what is the dividend you will be getting in first, second, third year, and because after that the growth is going to stabilize, so you have found out the price. Fine, because for an indefinite period we cannot keep finding out the dividend receipt. हम आगे तक हमेशा के लिए dividend receipt ढूंढते नहीं रह सकते, and that is why we find out the price, that okay, this is going to be the market price, and market price in the third year reflects your expectation of receiving dividend in all the upcoming years. That is why this calculation has been done. Now, question number 19, you have to do it on your own. Based on 3-stage dividend discount model, you have to calculate dividend per year in year 3 and its present value. Very simple question. You have been given the EPS growth rate, dividend payout has been given. Just a bit twisted question, right? You have to do this particular question on your own. Formula has been given. The PDF would be shared with you in case if you want to see the answer. Now, as per the 3-stage dividend discount model, the following values have been given. Present value of the dividend during high growth phase is 14 rupees. PV of the dividend during transition phase 25 rupees. And terminal value, that means at the end, this is what the market price we are expecting, and this market price tells us that whatever dividend expectation we have in the all upcoming years, आने वाले सभी सालों में जो भी हमारी dividend expectation है, this market price or the terminal value represents all of it. Okay, so now they have asked you that following rates, now find out the intrinsic value. What we have to do in the intrinsic value? Just add these all three. Okay. Okay. So total intrinsic value, high growth phase value, transition phase value, as well as the terminal value. Now next we have the company M has the following financials. EBITDA has been given, earning before interest, taxes, etc. Depreciation, now book value of the assets is 2000 crores. Sales has been given 5500 crores. Okay, average industry valuations have been given to you. Expected value as compared to the EBIT. Expected value as compared to the book value and as compared to the sales. So you have to find out the estimated enterprise value of the company M using the EBITDA basis. EBITDA आपको दिया हुआ है, right? EBITDA has been given to you. You just have to multiply this with the 12.75, right? And you will get your answer. So this is what the industry average is. If you have this much of EBITDA, what is the expected value or the enterprise value that we are expecting on the basis of the EBITDA? Now, based on the same data, what is the average estimated enterprise value using all three valuation approach? तो बाकी के सारे आप valuation approach अगर use करेंगे तो average enterprise value आपकी क्या होगी? 3 divided by all these three valuations divided by 3. How they have done? So book value basis में कैसे किया है? देखिए आप, book value of assets 2000 crore, right? Multiply it with this. They have found out value on this basis, on this basis, on this basis, and then they have done the average of it, right, to find out the valuation. Now, price to earning ratio based on fundamentals. So company has the following data: return on equity 20%, cost of equity 15%, retention ratio, that means how much of the earning you keep with yourself and how much you pay out as a dividend. So this is retention ratio. Dividend payout ratio is obviously if you are giving the 70%, if you are keeping 70% with you, obviously you are giving out the remaining 30%. So for incremental price to earning ratio, they have found out. So they have tried to, they have asked you to calculate. So how much you are distributing as dividend, right? And then your rate of return, return on equity, right? And multiply it with your retention ratio. So 0.3, 0.15, your return on equity, 20% multiplied by 0.7. This is what 30. It is our P ratio, incremental ratio. Remember that. Over here, this is the cost and this is the return that you are expecting. Okay. Now, if this is the return you are expecting and 70% you are keeping with it. Okay. If I have got suppose 1 rupee, but eventually I am not able to keep the entire 1 rupee. I am only able to keep 70% of it. So that means how much am I earning? Okay. कितना मैं earn कर रही हूँ? This is what it reflects. This is what it reflects. Okay. Now, price to book value ratio. A company has return on equity, cost of equity as 18%, dividend payout ratio 0.5, growth rate has been given 15%, price to book ratio they have asked. So over here you are going to use C, ROE multiplied by what you are using as dividend payout and just divide it right. So what is the return that you are expecting? 25%. What is the cost of equity that you are having? 18%. What is your growth? 0.15. Right. What is the dividend payout? That is 0.5. And you will get your price to book value ratio. Now, price to sales ratio on the basis of fundamental, again net profit margin, growth rate has been given, dividend payout ratio, cost equity is 19%. Simple. Over here, net profit margin you have to use, multiply it with 1 plus growth rate, then multiply it with how much you are keeping with yourself, that is dividend payout, how much you are giving out, right? And it would be divided by your cost less growth rate. So this is the formula that depicts your price to sales ratio. Okay. What is your profit margin, growth you are expecting onto it, and how much of that you are distributing divided by the cost minus growth rate. Next, you have ABC company has the following data. Tax rate is given, reinvestment rate is given, weighted average cost of capital and growth rate. You have been asked what is the enterprise value divided by EBIT multiple based on the fundamental formula. Okay, let's have a look onto it. What you are reinvesting, okay, what is your tax rate divided by what is your cost of capital less growth rate, right? So this gives you your EV divided by EBIT formula. That means your ratio between your expected enterprise value and your EBIT you can calculate by these fundamentals also. That means if I know my EBIT, suppose if my EBIT is 100, I for sure know that my enterprise value is going to be 700, right? This is what this ratio depicts. And how we have been able to calculate this ratio? By using the tax rate, how much we are reinvesting in the business, what is my cost of capital, and what is my growth rate. Now, you have to free cash flow multiple you have to calculate based on your formulas, that is weighted average cost of capital and growth rate. It is simple, 1 divided by weighted average cost of capital less growth rate. You will get your free cash flow as well as your enterprise related relation. So that would be 20. EV divided by book value related multiple, how you are going to calculate it. So just see the formula for that also. You have the formula ROIC less growth rate, weighted average cost of capital less growth rate. This is what tell you that what is your expected enterprise value and what is your book value related relation. So whatever is your book value, the enterprise value is 3.5 of that. Now, ABC Limited has a total paid up capital, equity capital of 2000 crore divided into 200 crore equity shares. The replacement cost of its plant is 50,000. The value of its 50% stake in MNP Limited is 60,000 and cash holding 9,000. If the outstanding debt is 9,000, what is the intrinsic value per share? Book value approach. So you just have to add the assets, right, and deduct the debt. You have got the value, right? Just divide it with the number of shares. You will get your net asset value per share. आपकी per share क्या value है? This is what your book value is. Now XYZ Limited has total adjusted assets worth 72,000, outstanding liability 12,000. Company has 300 crore equity shares, so adjusted book value very easy to calculate. Just minus the liabilities from the assets, you will get your book value, divide it with the number of shares and you will get the value per share. Now, which of the following best describes a congeneric merger? So, a merger between companies which are linked by similar technologies, we'll call it as the congeneric merger, right? Over here, this is also important for you to note. This is differing from horizontal mergers where we are merging with the competitors, or conglomerate merger where we are merging with unrelated businesses. For example, an airline is merging with a FMCG. So that would be an conglomerate merger, right? Now, what is the main characteristics that differentiates a hostile takeover from acquisition? So, hostile takeover is done without the consent of target company. And over here, you can take the example of Twitter, how the Twitter acquisition was done. This was an example of the hostile takeover. This was not very consent-based takeover, right? Then you are having ABC Limited is an unlisted company that merges with XYZ Limited, a publicly listed company, to get listed without going through the IPO. This is an example of what? This is an example of reverse merger, where you are merging with a publicly listed company. Now, which of the following transactions involve the sale of business unit as going concern for a lump sum? So, this is called as slump sale, where you are selling majority of your assets. Okay, means you have said that these are my assets and give me just 100 crores. I have not assigned valuation to my individual assets. No, I have just done a block deal. That is slump sale. A Limited acquires B Limited in a share swap merger. Prior to merger, A Limited was having EPS of 3, price per share 60, P ratio was 20, shares were 10 lakh. B Limited EPS was 3, price per share 30, P ratio was 10 and shares were this. The exchange ratio was 1:2. That means for 1 A Limited share for every 2 B Limited share. So what is the combined EPS and P ratio? So over here you have to do the calculation. See, combined earnings would be 30 lakhs, 30 lakhs, 60 lakhs, right? So your combined EPS is going to be, total shares that you are going to issue is 15 lakhs. Why 15 lakhs? So for every 2 B Limited share, 1 A Limited share would be issued, right? So total A Limited के शेयर कितने हो जाएंगे? 10 लाख खुद के और 5 लाख नए जो और इशू किए B Limited वालों को. तो total 15 lakhs. 60 lakhs divided by 15 lakhs is 4, right? And what would be your P? So 4 is your EPS, right? And your P has been given 15. That is an efficient market. So price would be 60 rupees. Now, if the market behaves inefficiently and continues to assign a P ratio of 20 to A Limited even after merger, so what would be the new share price? अगर P ratio change कर देते हैं even after merger के बाद में, so price per share क्या होगा? 4 तो आपका EPS हो गया, 20 is the P ratio, so price would be 80. Total share is 15 lakhs, so the market value would be 12 crores. Combined market value would be 12 crores. Now, Firm A is valued at 100 crores, firm B is valued at 25 crore. Merger is expected to result in cost saving with a present value of 25 crores. If firm A offers 30 crores in cash to acquire firm B, what is the net present value of the merger for firm A? So what you have to do is see. This is how you have to find out the benefit. Look at it. Present value. What is the cost that is being costed for the A and B? Right, you have found out the benefit. What would be the cost to A? 30 crores in cash less 25 crores, 5 crore, and what would be the net present value? So benefit less cost, that is 20 crores would be the valuation over here, because the firm A has been valued at 100 crore, firm B has been valued at 25 crores, right? And the merger is expected that it was going to result at a saving of 25 crores, whereas the firm A has offered 30 crores in cash for acquiring. So this is how you are going to find out the valuation for the A company. Now, firm M that has 100 per share, 20 lakh shares acquires firm N. Right, merger brings benefit worth 2 crore and firm M offers 5 lakh shares to firm N shareholders. So what is the true cost of merger? Over here, see. So value of firm M is going to be what? 20 crores, right? Firm, this is 20 crores. Firm N के लिए कितना होगा? It would be 4 crores, right? Merger is going to bring the benefit worth 2 crores. So the total of these two, 20 plus 4 plus the benefit that they are, see, they are having the existing value as this. They'll add more value by this merger. So it would be 26 crores, right? Now the fractions of shares that would be owned by the N in the merged firm would be 5 divided by 25, because the firm M is offering 5 lakh shares to firm N shareholders in exchange. कितने दे रहे हैं? 5 लाख shares, right? So in the actually in the firm M already there are 20 lakh shares. 20 लाख already हैं, इतने इन्होंने N firm को दिए, right? So what is the fraction that would be owned by the N in the merged firm? In the total firm, there would be 25 lakh shares. Out of that, N firm has 5 lakh shares. So 0.20. So what would be the cost to M? 0.20 multiplied by 26 crore less 4 crore, right? So over here 5.2 crores less 4 crore is equals to 1.2 crores. That's the cost. Now, this is what this question and the previous question, they are really similar in nature. How so? See this over here. Cost to M for purchasing this particular company, the company M has to incur 5.2 crores, whereas the valuation of company N is just 4 crores, right? So that is the extra cost that the company M has to incur. Okay? NPV to both firms under stock compensation. So in the same scenario, you can do it just as your work, right? This is a super easy question over here. They're asking what is the NPV to firm A and firm B. दोनों के लिए NPV आपसे पूछा गया है. You have been given the total benefit. You have been given the cost to M. NPV क्या होगा? Net present value, benefit less cost. So you easily calculatable. And then NPV to N, that is firm B, would be the cost to A. जो उनको cost लग रही है वो दूसरी firm का obviously benefit होगा. So 1.2 crores. Now company A is acquiring company B. The book value per share is 60. That of company B is 90. So what is the book value based exchange ratio and what is the key limitation of using book value? See over here, exchange ratio, दोनों की book values को आप divide कर दीजिए. Book value of A divided by book value of B, 0.67. But it does not reflect the real time economic worth, and that is why it is problematic. Now, the market price per share of acquiring company is 200. Market price per share of the target company is 50. So what would be the exchange ratio based on market price? Just divide it, right? And it is obviously a valid because market prices are actively traded. And that is correct way of finding out the exchange ratio. Now, if the discounted cash flow value per share is 80, दैट ऑफ टारगेट कंपनी 60. तो आप इस बेसिस पे कैसे एक्सचेंज रेशियो निकालेंगे? 60 डिवाइडेड बाय 80, 0.75. एंड डिस्काउंटेड कैश फ्लो टॉक्स अबाउट फ्यूचर अर्निंग, सो दैट इज व्हाई इट टॉक्स अबाउट द लॉन्ग टर्म सस्टेनेबिलिटी. Discounted cash flow means what you are going to earn in future, what is the present value of that today. Spin-off characteristics. So which of the following statement is true regarding a spin-off? See, spin-off is when we are creating a new entity without changing the shareholders proportion. This is called as the spin-off, right? Next is equity carve-outs. Equity carve-outs क्या होते हैं? So equity carve-outs involve a public offering of a subsidiary shares, right? Versus spin-off. See over here, in an equity carve-out, the parent company creates a new entity, sells the stake of it to the public via an IPO and thus generates cash. In contrast, a spin-off involves no public sale and no cash inflow. You just have created a new entity. Whereas in equity carve-out, you have just separated an entity out of you and have issued the IPO. Now, split-up structure क्या होता है? So, a parent company is dissolved and replaced by an independent legal entities. Over here, breaking up the entire company into multiple independent entities, each become a legally separate company and the original parent ceases to exist. So this differs from the spin-off and the carve-outs. So these were the questions that we had to do in your valuation, acquisition and merger. Do practice these questions well, and thank you so much for joining in.